Hello, welcome back. Today I'm going to be talking about a recent article released by Forbes that talks about how the current expiry of options is going to massively affect the Bitcoin price. I think the numbers they're talking is saying that about 930 million contracts are going to expire on the 26th of June, so that being tomorrow. I'm making this a bit late, but as you might have noticed, I've actually sort of changed my space a bit, got a new little light so you can see me a lot better. So I guess I'm just trying this out for now. How the biggest issue with this article, it doesn't actually talk about why there'll be a negative impact on the price of Bitcoin. And I'm going to link that below the actual article itself so you can take a look for yourself. Other than the main reason might be that there's large amounts of liquidity being sucked up by these options markets. But the amount of money isn't really particularly massive. When you actually consider the amount of price that goes into buying an options contract as opposed to actual physical Bitcoin. So yeah, basically the current derivatives market in Bitcoin is irrelevant to the underlying asset because they're cash settled, meaning that at the end of expiry of the contract, whether it's futures or options, in the vast majority of cases, particularly in the ones that are talking about here, these options contracts are actually cash settled, which is like saying that the value of the US dollar is going to be affected by the success or failure of a casino in Las Vegas. Although the casino's using US dollars, it doesn't, as sort of, a way of betting, whether the casino makes or lose money has absolutely zero effect on the use of US dollars or the actual underlying US economy. Sort of like that. I think, however, that this will be, if there is a price move, it'll be mostly psychological, because now people have created this thing. People are going to be worried about what happens tomorrow. If there's a dip, then people will just start freaking out. We'll see how we go, though. I could be wrong. So I'm not really going to get into a massive how options work class or anything like that. However, I just want to give a brief overview of how options work, and then hopefully you can understand how this won't really affect at a fundamental level what we're seeing in Bitcoin. So basically there's two types of option. There's a put and a call. So a call option is the right to buy, but not obligation to buy an asset, an underlying asset, by a certain expiry date. A put, on the other hand, is the option to sell an asset at a fixed price at a later point in time. And that's basically how they work. And then there's a premium paid if you're buying a call or a put, and then you can earn a premium if you're selling a call or a put. So there's really only four states of being in the options market. There's selling put options, buying put options, selling call options, or buying call options. They're literally your four options, as opposed to what we see in the normal markets, which is either you're a buyer or a seller. You have cash and you want to convert that into an asset. You have an asset, you want to convert that back to cash. In basic ways. Obviously, we know that in crypto it can get a little bit more complicated than that, but essentially it's a fairly binary system. So hypothetically, if I was going to buy a call option on Bitcoin at, say, $9,000, like a call at a strike price of $9,000, set to expire in about 8 days, which is the 2nd of July, it gives me the right, but not the obligation, to buy one Bitcoin at $9,000 US on or before the 2nd of July. So if basically at expiry by the 2nd of July, Bitcoin goes up to, say, $10,000, I would have made $1,000 profit, less the cost of the contract. If Bitcoin goes down to $8,000, all I've lost is the cost of my premium. So that's why options are seen as being a pretty good risk mitigation product. Currently, Bitcoin futures are trading at about $9,100, so $9,100. This is the underlying asset for all these option contracts. If I get a $9,000 contract, as I talked in my example right now, because it's an in-the-money contract, meaning that it's trading lower than the current price of Bitcoin, so it means that the contract's already made $100 because I have the option to buy Bitcoin at $9,000, and the current price is $9,100, so I'm already $100 in profit on that contract. The premium is going to cost me about $380. If I decide to go for a contract selling at a strike price of $9,250, the call contract will cost me about $242 at the moment. Now, as the price gets higher, the contract cost, the premium gets less and less, because the likelihood that that contract will be profitable decreases as well. So for example, if I want to buy a contract for say $12,500, which means that in order to make money, Bitcoin needs to get over $12,500 in the next 8 days, so fairly unlikely. The premium selling for about $4. So you can pick up these contracts super cheap, but more than likely, I'd probably say very likely, they will expire completely worthless. So it's just throwing $4 away. However, there is someone on the other side of that equation that is selling those contracts, those options contracts, for $4, and they are obviously happy to take the risk to say, well, look, yep, I'll sell someone, Bitcoin at $12,500. So if Bitcoin skyrockets and gets to $100,000, they'll be out a lot of money, but they think it's a fairly low risk. That's why they're happy to offer it so low. So with all this in mind, you can see how options are a bit more of a complex investment than simply purchasing something, as you have 4 potential states that you can be in. And then you also have to factor in not only that, you also have to factor in the expiry date. As the expiry date increases, generally speaking, your premium will increase. So for example, if we look at a $9,000 option expiring on the 25th of December, it's going to cost us about $2,000 because of obviously the risk to the person selling you the option is a lot higher. Back to the original point though, why doesn't this have effect on the underlying Bitcoin price? Is because all of these contracts, as I said before, are completely settled in cash. So for example, if I, make my, buy my $9,000 contract, Bitcoin goes up to $10,000, and I say, yep, I want to buy your Bitcoin off you for, $9,000. Then I've got a Bitcoin at $9,000 when the market's selling it at 10. Great, right? However, the counterparty doesn't have a Bitcoin, and that's how this market works. They're not going to give me a Bitcoin. They're just going to give me the amount of money. They're just basically going to give me the cash difference. Which is very different to how it works in the share market. So I'm going to basically make the $1,000, and that's how it's going to work. So you've just got to be really careful when you have a look at some of this news when they're talking about there's $900 million of open interest, blah blah blah. So and this is how these markets work. They're not, and if there is any profit to be had, it's cash settled. So it means that the underlying price of Bitcoins, no one is going to have to buy or sell a single Bitcoin in order to facilitate the execution of these contracts. And that's a really important thing to understand, the same as the futures market. They're all cash settled. The idea that this $930 million will have a massive impact on the they're basically saying that it's a significant portion of the daily trading volume of Bitcoin, which it is. But you've got to understand this $930 million options expiry is completely irrelevant because the cost of those options contracts have already been factored in by the people who bought and sold them. So the people have been, like I said, a $10,000 or a $9,000 contract to buy Bitcoin is going to be super cheap. So although the contract is worth, say, $10,000, the premium would have only been maybe $100 or less, especially because we're looking at these. They're saying that 75% of them are at $11,000. Now, Bitcoin hasn't traded at $11,000 since August last year. So a lot of these contracts would have been bought out of the money. So they would have been bought way above market with the expectation that the market would have gone up. And then these contracts will be then profitable and they'll earn. Now the people selling them, because they're out of the money, will be a lot cheaper than the example I used before. As in, I think the contracts I was looking at were like slightly out of the money was about $250. And these would have been way out of the money by about $1,000. So they would have been, I'd probably say sub $100. I haven't actually looked, but I haven't actually looked at those ones because they're expiring now, and it's kind of irrelevant. But at the time, would have been under $100. Would have had to have been. So we're not talking about a massive churn of cash either. Probably in the order of sub $10 million. In all honesty, it's not crazy when you compare it to the rest of Bitcoin. So even if the entire options market crashes, all the operators go out of the business and walk away with the cash, the impact of this is actually incredibly minor and really only is going to make a difference in our heads. So thank you so much for watching. I've got a really cool video coming up on comp and DeFi, and another interview with a guy from the DeFi space who's fairly popular. So if you want to get notifications of that, please hit subscribe. Otherwise, like the video, and thanks for coming in. Bye.